There we go, and we are live. So we'll just wait a minute, see everybody jumping in now. Terrific. Good morning, everyone. My name is John D'Antona, and I'm the Director of Marketing here at Capus. Welcome to our monthly research call. As people log in, we would like to thank all of you for taking the time out of your busy day to spend with us here. We hope that you find the following information in today's call useful. In order for us at Capus to serve you better, there will be a brief survey at the conclusion of the call that we'd appreciate you filling out. It helps us deliver a better product. But before we get started, let me just get through the legalese. The opinions expressed by the featured speakers today are neither those of Capital Institutional Services nor any of its employees. This presentation is not, and nothing in it should be construed as, an offer, invitation, or recommendation to sell, or a solicitation of an offer to buy any securities that might be mentioned today. And now, on with the call. First up to speak, providing us with a few remarks on Capus and operations, is Dave Choate, our COO and Executive Director of Sales and Trading here at Capus. Take it away, Dave.
Thanks, John. I've just got two things I wanted to share with the group. The first is our May 6th call, not a research call, but we are going to do a virtual roundtable. Wanted folks to know about it, be on the lookout for email invites. We'll be discussing low price stocks and the regulatory guidance related to those stocks and how to avoid the AML compliance issues that seem to be popping up more and more on low price stocks. So that'll be May 6th. Be on the lookout for invites for that. And my second item is out of the Capus Q1 universe data. So you may know, in addition to trading stocks, bonds, options, Capus also analyzes over $600 billion in equities traded annually. Most of this comes from custody data. It's not necessarily our trading desk, but our clients. We refer to the data set as our Capus universe. Looking at Q1 2021, it was interesting to see that commission rates, for the first time in a while, were actually up. It was the highest commission rate number, and I'm looking at full service rates. This is the commissions that are paid most likely for traditional research, bundled research, CSA, third party, all of which might be considered soft dollars. The commission rates were the highest since 2017. We also noticed that over 75% of the trades were done at full service rates. This is, for comparison, higher than last year's 73% and quite a bit higher than 68% in 2019. So what it all means: MiFID II pressed commission rates by adding global disclosure guidance. We've seen retail platforms trading at zero commissions. So it's interesting to see that institutional money managers continue to use commissions to acquire brokerage research. So as a fan of 28E and its positive impacts on our industry, I think it's comforting to see that the market forces have not caused our industry to eliminate the use of commissions for research. So if these statistics are helpful to you, if you want to know more about the Capus universe, please let us know, and we're here to help. With that, John, I pass it back to you.
Thank you, Dave, for providing us with that update. And now I'd like to turn it over to Nick Colas. But before I do, please note that Nick will take questions at the conclusion of his remarks. We ask that you please type them into the Q&A portion of your Zoom, and I will be sure to get to them. Also, again, there will be that research call survey, and we'd appreciate everyone taking a couple minutes to complete it and help us serve you better. Now, Nick Colas is one of the two founders of DataTrek, a research company focusing on market fundamentals designed to make the investment process more profitable, robust, and efficient. Colas is a 30-year plus veteran of Wall Street with experience in equity research, money management, and investment banking. From 1991 to 1999, he was the senior equity auto analyst at First Boston, which is now Credit Suisse. From 1999 to 2001, he was an analyst and portfolio manager at SAC Capital, reporting directly to company founder Steve Cohen. Most recently, Colas was director of research and chief market strategist for First Rochdale Securities and then Convergex Group. Nick, as always, welcome.
Yeah, thank you so much, John. And thank you all for taking the time to listen in. We love doing these calls with the Kappas folks and always find the questions and the comments that come both during the call and after really interesting and important. So thank you all for taking the time to listen in. The comments that Jessica and I will have today basically break down into 4 sections. We're going to talk about some U.S. politics to start off. Then we're going to review the state of U.S. and global capital markets, focusing on potential pitfalls that we see coming up, as well as highlighting groups that we like. And then Jessica is going to review 2 topics as well. The first is U.S. equity market volatility, which is of interest and concern to everybody on this call, and then discuss some, I think, very underappreciated facets of emerging market tech exposure, which is a really important topic and one that I hope you find interesting and useful. So let's just kick off and talk about some U.S. politics to start. 2 items on this. The headline here is that for investors, everything about U.S. politics basically revolves around the size and longevity of fiscal and monetary stimulus. That is why politics matters to capital markets. We've done a ton of work on this topic over the years. I can tell you that it doesn't honestly matter which party controls the White House, which party controls Congress in terms of stock market returns. The noise around this topic is pretty considerable, but the numbers are pretty clear. It doesn't actually matter. Policies matter a whole lot more than party or even people do. The first thing I want to discuss with politics is the U.S. midterm elections, because we had the elections last year. We have our current president and Congress. But what really matters to markets, I think, is what happens during midterms. And here's why. When the president is unpopular, his party loses a lot of seats in the House and in the midterm elections. And Gallup did some really useful analysis of this data recently. And it showed that with Biden's current approval rating of 54%, that's a little bit more than half. When a president has between 50 and 60% approval, kind of where Biden is right now, the president's party loses an average of 28 House seats in the midterm elections, 28 losses. Over 60%, it just breaks down to 3 losses on average, and all this data is since 1950. So it's really important that Biden get over 60% approval by midterms, because the current House Democratic majority is only 6 with 5 vacancies to fill. So the House is democratically controlled, but only by a very thin margin. And the midterms are super important. Every Democrat, everybody in the White House understands this math. Everybody knows that the president tends to lose seats in the House if he is not particularly popular. So the goal here is to hold the House, which means that we need a very robust economic recovery by 2022, which is why you see the Democratic Party and the Biden administration pushing so hard on fiscal stimulus, on this infrastructure plan, and they're going to do everything they can to get this through Congress and get more money into the system. And I think that's an important backdrop because it explains a bit about why markets have been so resilient. It isn't just the stimulus that we've had that's important, it's the stimulus yet to come. And this issue with the midterm elections puts a very finite point on that. Biden has to get to over 60% by midterms in order for the Democrats to have a chance of holding on to the House, because that lead is so slim. Issue number 2 in politics that we spend a lot of time thinking about is the new Federal Reserve chair, because Jay Powell's term is up in Feb 22. And the question is, will he be reappointed, or will we have somebody new, and will markets have to deal with potentially new messaging, a new Fed chair, and so forth? We did a survey last month of our clients here at DataTrek with over 300 responses from high net worth individuals and a lot of institutional money managers, ranging from hedge funds to RIAs, family offices, and so forth. And the bottom line was that our survey respondents thought it's basically 50-50 if Jay Powell gets renominated or not. Our personal perspective is that he won't be renominated, even though he's done a solid job because the Fed chairmanship is such a plum appointment that it seems doubtful that President Biden would let it just renew to a Trump appointee. It is possible, but we think less than likely. And this is why Chair Powell, who understands this very clearly, is giving guidance out through 2022. When you hear him talk, even yesterday at the Washington Economic Club, you'll find that he's giving guidance through the end of his first term. He's giving guidance for the next Fed chair should he not be reappointed. And the goal here is to provide markets with some continuity and some ability to see through his potential non-renomination and into somebody else's taking the role. Look, our personal perspective is it's probably Atlanta President Bostic who has the best shot at being the next Fed chair. But we did want to show you that the fact that a lot of investors do think Powell will be reappointed. That may or may not come to pass. And should it not, there's going to be some question of who the next Fed chair is and what their policies are going to be. But at least for the moment, we do have some visibility through to the next Fed chair in terms of basic monetary policy. So those are the two things that we think where politics really makes a difference in the current market narrative. The second item that I'm going to cover is the state of global capital markets and how they're interpreting a US and global economic recovery. And I have 3 points on this. The first point is, and this is super important, the US is by far the best positioned of any large global economy to come out of the pandemic recession quickly and robustly. And the reason for that is very straightforward. Fiscal stimulus of $5 trillion, which is what we've had here, is much higher than what the Europeans have done, for example. Europe has spent some money on fiscal stimulus, but nowhere near even $1 trillion all in versus the $5 trillion we've spent here. There was a recent New York Fed analysis, which I would encourage you to go look at on the New York Fed blog, that compared savings rates and consumption rates among consumers in the US, Europe, Japan, and Canada, and it over the last 12 months. And it showed very clearly that the US consumer both cut back their spending less than the average of all those other countries and saved almost as much as the Japanese have done over the last 12 months, which, if you know Japanese savings rates, is simply astounding. And you end up with a situation where the US consumer is in a really good place to come out of the recession as employment improves with high levels of savings, reduced levels of debt, and not having broken their consumption patterns as much as, say, the European consumer has. On top of that, we have much higher vaccination rates here than in Europe, which we all have seen. Quite sad that the Europeans have not been able to do it as quickly as we have. And the US vaccines are much more effective than the Chinese versions, which means that on average, the US population will be vaccinated and be effectively vaccinated at a much higher level than even China. And as you've all seen, Europe is still doing lockdowns selectively. They're really still struggling with the pandemic, where the US is clearly coming out of it in a pretty robust way and increasingly successful way. The bottom line here, and this goes back to my time as an auto analyst that you heard John talk about, is I always view cyclical recoveries through two basic levers. The first lever is the consumer's ability to spend, meaning, do they have a job? Do they have savings? Are they fairly secure in those things? And the short answer is the US consumer absolutely is solid on those points. We see it in savings rates, we see it in increased employment, and that's all solid. The other issue is the desire to spend, and that's basically consumer confidence. And there, the US is actually in a pretty good position because we've had pretty slack consumer confidence, but it will improve. Consumer confidence tends to be a bit of a lagging indicator. Consumers will spend, but still say that their confidence is pretty low. But when their confidence improves, they spend even more. And that's kind of the two-step that you need in order to see a full-fledged consumer recovery, which we're much more confident will happen in the US than it will happen in Europe. And that is why the US is the best positioned. Other countries, say Japan, for example, very high savings rates, but their consumer confidence is actually lower right now than it was during the financial crisis and the Great Recession in 2009 and 2010. They're going to be digging out of this a lot. I think for a whole variety of reasons, it will take them a lot longer. China, actually, consumer confidence right now has fully recovered from the pandemic recession, which is amazing to see. Their confidence levels are much higher than the US, but it means they don't have that much more to go. And in a recovery, you want to see a bounce in confidence and improvements in savings and income. And the US really fits that bill the best. So That's one big reason why we like US stocks over EFA, over EM. The second point, and this is something I think where the market's thinking has evolved, is that markets now very firmly believe the US recovery will be sharp, as we're seeing right now, but also last several years and not create systemic inflation. And that's like a counterintuitive kind of thing to say, but let me walk you through how I think the market's thinking about it. Look, for example, at say 10-year yields. 10-year yields have just gone flat out nowhere over the past 2 months. Why is that? Inflation seems to be ramping up. We see that in the PPI numbers and the CPI numbers. And the answer is the market's very clearly thinking that this inflation is going to be transitory. And the way we know that is because 5-year tip spreads, the inflation rate embedded in 5-year tips, is actually running a good 30 basis points over 10-year tips, 2.5, 2.6 versus 2.3% for 10 years. That's never happened before in the history of tips markets back to 2003 when they started. 10-year inflation's always higher than 5-year inflation, except for right now. And that anomaly tells us that markets kind of believe what Fed Chair Powell is talking about in terms of transient inflation hitting inflation for the next year or two, but not sustainable. Now, this is a super contentious topic, and we hear this from clients all the time. And I think the bottom line is this: if you want to believe in inflation, systemic inflation, you have to come against two arguments. The first is demographics. The US is an aging population. It's just getting older and older every year. And if we've learned one thing from the Japanese inflation experience of the last 20 years, is demographics tend to push down inflation in a very pronounced way. Older people simply spend less. They are on fixed incomes, or they're ending the part of their work life where they expect raises and improving wages. And so they just tend to spend less. And so demographically speaking, it's hard to make a long-term argument for inflation in the US. Now, you might point to money supply. Very, very fair point, because we've had a huge increase in the money supply. However, the velocity of money is still very slow. Velocity of money is basically how much money there is in the system, checking accounts and money market funds and liquid cash, and then how many times that money is used to create GDP. Back in the 1990s, even the 1980s, you got to a peak of 2 times velocity, which meant that every dollar in the system turned in the economy twice. The most recent numbers are just barely over 1.2, 1.3. So yes, there's a lot more liquidity in the system, but it's just sitting there. It is not circulating a lot in the economy because of high savings rates and because places like banks have to hold more capital than they ever had before because of new regulations. So velocity has just plummeted. And so it's hard to compare the long-term history of velocity and say, yes, velocity is going to increase dramatically because we have all this money and it's going to get spent. The bottom line, and this is something that I think is still an evolving conversation in markets, but the way we think about it is that in this inflation issue is obviously both the biggest plus to markets and the biggest potential negative, the biggest pitfall, if you will. Because right now, the market is 100% anchored on the idea that we are going to get a snapback, that inflation will run close to 3% for maybe the back half of this year, but it's not sustainable. And that's why 10-year yields are so low. Those support valuations, and it gives you the idea that you're going to have a long-lasting US economic recovery that will go through 2022 and 2023 and 2024, and you have the chance for higher earnings. Again, very contentious issue because we totally respect the idea that with all this money, there might be some inflation. But when you overlay demographics and you overlay the shock that consumers have had, it seems logical to think that they're only going to release those savings slowly. They will spend more, but this is going to be a 6-month flush. It's going to be a 2 or 3 year period where consumers spend ever more as they grow more confident in the economy. Now, third point on markets, what do we like here? Basically cyclicals. That is our basic call to clients. We're looking for anything with good earnings leverage. And we define earnings leverage as earnings growth, EPS growth faster than revenue growth. That's our basic benchmark. Let me give you an example. Technology right now, the big tech companies are expected to show about 1.8 times earnings leverage this quarter. That's basically Google, Apple, Amazon. If they print 20% revenue growth, they're going to show 36% EPS growth, 1.8 times revenue. That's a pretty good number. That shows good earnings leverage. But Home Depot is expected to show 1.8 times as well. And honestly, Home Depot's probably got a better upside story to show even more earnings leverage because the housing cycle is still so strong. And look at Home Depot's stock. That thing has just been making new highs virtually every day for the better part of a month because the market understands that the consumer is spending and spending more, and they want to be in places where you can get earnings upside based on that story. Caterpillar, big industrial, 5 times earnings leverage coming off a low base, but much higher than Depot, much higher than technology. So the bottom line is we like energy here. We like financials. We like anything consumer cyclical. We're pretty neutral on tech. We don't think it's a big underweight, but I think this quarter is actually more important for big tech companies and big tech stocks than people really appreciate because they've got to show that they can have really good earnings leverage even after the pandemic pop that they got. Everybody rushed into tech last year because it was a safe parking lot. Now nobody wants to be in the parking lot. They want to be back on the street, traveling around, playing cyclicals. And so tech's got a lot to prove here. And we're pretty negative on staples, utilities, real estate, anything with that's a bond substitutes because we don't see much going on. We do see rates slowly climbing higher, something closer to 2% by year end. But again, because the markets really embrace the idea that this is going to be a kind of grinding, slower recovery than just a big snapback, rates are going to move higher, but only very slowly. So let me sum up my thoughts and then turn it over to Jessica. Our basic point of view is the global economy is not going to be in global synchronized growth mode for several years, and that's actually a good thing. The US is coming out first. Europe will follow along next year. It will add to the global recovery. Rates will stay low, and US politics, as I outlined at the top, are actually a very good tailwind for global stocks, for US stocks especially. The China recovery has already kind of happened, honestly. We see that in the consumer sentiment data, we see it in traffic data, but it doesn't really add a whole lot to 2022 and 23 incrementally. There's other issues in those stocks in that market that Jessica will cover. So I'm going to wrap up my comments and hand it over to her. Jessica?
Sure, thank you, Nick. So I'm going to briefly cover 2 different topics. The first is on the cadence of volatility through a crisis and how that relates to US equity returns. So we, like everyone, do look at the VIX, but our preferred measure of volatility is by counting the number of trading sessions when the S&P 500 moves more than 1% to the upside or downside from close to close. And that's because it captures how much investors feel real-time volatility, since any one-day move greater than 1% to the upside or downside is one standard deviation from the S&P's mean daily return. Now, last year was very unusual in that there were 110 1% days in 2020, which accounts for almost half of trading sessions last year, and it's roughly double the annual average of 54 over the last 6 decades. Now, the S&P has only posted over 101% days in a year 6 other times over that time frame. And after those 6 outlier years, the S&P went on to post an average of 27 1% days in the first quarter of that second year, which is about double the quarterly average of 13. But in Q1 of this year, there are just 18 1% days, and there's only been 2 more since in Q2. So our bottom line here is that volatility is returning to normal quicker than prior years of outsized volatility when there is over 1% days in a year. And the reason for this is, of course, lots of liquidity in the US economy and financial system, which helped corporate earnings rebound and valuations stabilize quickly. In addition to that, obviously, there's a known solution to the crisis with vaccines, and lower equity sector correlations have dampened volatility faster than post-crisis periods. So for what this means for returns going forward, volatility and US equity performance are typically inversely correlated. Now, yes, the S&P's had a great snapback of over 10% year to date, and part of that is volatility quickly declining. But past cycles, think the early 2000s or after the financial crisis, show the transition to a low volatility environment often means positive, but below average annual equity returns, like 10.7% in 2004 or 2.1% in 2011 versus the annual average of 12% on a total return basis over the last 6 decades. Now, the other thing to consider that's important is the S&P was up 31 and 18% over the past 2 years. And it's extremely rare for the S&P to post double-digit returns for 3 consecutive years with how efficiently markets discount the future. It's only happened in 3 periods. One was in the early 1960s, the other was in the mid to late 1990s, and the last was from 2012 through 2014. Now, 3 years of double-digit returns could absolutely happen, especially with the $5 trillion in stimulus that was just pumped into the system, as long as rates don't rise too high. But it would mean that markets underestimated forward earnings 3 years in a row, which again is rare. So I'll wrap up my first section by saying that we are still bullish on US equities, but we just understand that we have to moderate our expectations for this point forward, given that history shows returns are typically more muted after such a quick drop in volatility and already 2 years of strong double-digit returns. So now moving on to my second section, I'm going to briefly discuss what's going on in emerging markets and the Chinese stock market as well. So many investors use MSCI emerging markets or MSCI China as a high beta bet on global growth. But there are some unusual developments going on in both indices, given that they are now heavily weighted to Chinese tech companies. So just to put some numbers around that, for example, 4 of China's largest tech companies, think Alibaba, Tencent, 4 of China's largest tech companies make up the top 10 holdings of the MSCI Emerging Markets Index for a total weight of 13.8%, which is a greater share than all sectors in the S&P 500 except technology. And over half or 6 of China's largest tech companies are also in MSCI China index's top 10 holdings, accounting for an even larger share, or 40% of the index. Now, the issue is that China has started cracking down hard on big tech companies after a year of a huge explosion of tech usage, which is having a chilling effect on Chinese tech that will last for a while. Now, Chinese tech regulation, we understand it may sound like inside baseball and it doesn't get a lot of attention, but it's important to, both EM and the Chinese indices. So just briefly explain what's going on. So this year we have been cautioning that China's efforts to curb big tech's power was growing more systemic than just Alibaba or its affiliate Ant Group. And that was very clear this week because the Chinese government used Alibaba as an example to warn nearly 36 of China's largest tech companies about violating their monopolistic practices or face, in their words, severe punishment. Now, we think this major overhaul shows that regulators are clearly playing catch up after, again, a year of huge growth for disruptive innovation in China. That's why the government has started specifically targeting platform companies, because those are the type of businesses that thrive during the pandemic by offering services like e-commerce to food delivery. Now, with such a large total addressable market of 850 million smartphone users, it's understandable how the long list of companies under regulatory review were able to grow so rapidly by offering a slew of offerings that leverage new behaviors. But this ecosystem did grow beyond regulators' control. To put this in perspective and contrast it with the US has less than 1/3 of China's smartphone users with just 260 million. And American regulators are currently mostly focused on just 4 tech companies: Facebook, Amazon, Alphabet, and Apple. So this is to say China simply just has a much larger market to oversee with many more players involved. Now, again, to cycle back to why this should matter to investors, again, many of the largest Chinese tech companies that were told to shore up their business practices make up a significant share of both MSCI Emerging Markets Index and an even larger share of the MSCI China Index. And as a result of this more regulated, less tech-friendly environment, it certainly hit investor enthusiasm in investing in EM or Chinese stock indices, with EM up less than 5% and Chinese MSCI China up less than 1% year to date versus, we're up now over 10% for the S&P year to date. So I'll close my second section out by saying that while people think of investing in emerging markets as at this point in the cycle as a juiced up way to leverage global economic growth, just remember that EM is almost 40% China. So it's levered to that economy and more importantly, Chinese tech, which is just at the beginning of a major regulatory crackdown, with the government playing catch up after again, a huge year of growth for disruptive tech. Now, this isn't to suggest, we don't like EM or to short it. It's just to point out that it may trade differently than investors classically expect at this point in the cycle due to both its regulatory overhang and those geographic and sector weightings of the index that I just outlined. So that will hand it back over.
Hey, John.
Yes, thank you so much, Nick and Jessica. Sorry about that. Just taking notes on my end. And at this time, we'd like to open it up to any questions via Zoom. Once again, for our participants, if you would just click on the Q&A button on the bottom of your Zoom menu or the screen, it will appear Q&A. Just press it, enter a question. We have one right now. And here's a question. From your perspective, are inflationary concerns mainly an issue facing the US due to our recent monetary policy? Or is Europe facing a similar narrative about the potential of rising inflation? And I'll leave that to either Jessica or Nick.
Okay, yeah, no, it's a great question. It kind of speaks to how much inflation can be a global topic versus just a national topic. Over the short term, the US clearly has the greater inflationary pressure because not only do we have the fiscal stimulus, but we also have an increasing amount of bottlenecks in some areas. So we see that in, for example, housing products, the things as prosaic as lumber, seeing massive inflation just because the supply chains are stretched. We're seeing it in things like automotive. Go look at the Manheim Used Car Auction Index, which is kind of a crazy indicator, but the Manheim Used Car Auction Index is just off the charts. The value of a used car in this country is up like 20% year over year because of this lack of supply in the new car market. So 1,000 little anecdotal examples kind of give you the perspective that when you juice the system with a lot of fiscal policy and then have supply disruptions, yes, you're going to get a lot of inflation. So it is largely a US issue. It is not as much of an issue in Europe as of yet. And look, we see that primarily like in oil prices. Like we like the energy sector, but we totally get why it's choppy because with this slow European recovery, you're just not going to get European fuel demand, European oil demand back to where it was very quickly. You might get it there by summer driving and vacation season there, but it's going to be a slow ramp. So in terms of national inflation, US absolutely, sort of leads the pack. In terms of things that really leverage global inflationary patterns like energy, going to be a slower ramp. We think the earnings leverage is there in energy companies to make some money in XLE or even PSCE, but it's going to be a slog. And these things tend to go in kind of episodic cycles. We're kind of in a down cycle right now for energy, but as long as Europe does eventually get vaccinated and get back online, global inflationary things like energy should pick up. But yeah, it's a great question and a great point. There's aspects of inflation that are national, and we're seeing it in the US. And then there are some plays where we need international inflation where it's going to be slower. And you see it also in like German Bund rates, French 10-year rates, a lot of negative rates still in Europe, because that system is still kind of in a modest deflationary spiral and won't come out of it until 2022 at the earliest.
Okay, Nick, thank you. We have another question here. Economic comparisons start to get much tougher in the second half of the year, and we will see year-over-year GDP growth dropping. How will that affect leading sectors?
Yeah, great point. We are right now in the easiest comps for GDP and inflation and retail sales that I think any of us will ever see in our lifetimes. And I go back to the early 1990s cycle. I thought was a pretty dramatic cycle. That's when I started covering the autos, and this puts it to shame. The short answer is, from a stock market perspective, it really comes down to this earnings leverage point that we keep kind of harping on, because what it comes down to is how much of an earnings surprise can you get in 2022? That really is what markets focus on. I always think markets kind of discount 6 months ahead of time. And so the market today is thinking about holiday 2021. And obviously with retail sales out today, that really gives you all the data point you need to know that holiday 21 is going to be awesome. 2022 is a different story. And there it really relies on earnings leverage, which means that you have to control those inflation things that we talked about. You can't really, if you're going to be paying more wages, higher wages, you need to offset it with some productivity growth, and you need demand to still be there. So to put some numbers around this, right now the street's at like 202, 203 a share on the S&P for next year. So $203 a share. We need it to be more like 220, 225 a share, because that's really what the market's actually expecting based on where we are today on the S&P. So the way I think about the link between GDP growth and leading sectors and the market overall is how much earnings leverage can these companies actually achieve? And I think the answer, and this is based on my cyclical history covering the autos for a decade, is that you're always surprised how much companies can make off a bottom. You know, I was surprised by how little they actually lost in Q2 and Q3 of last year. And I think you're going to be surprised as to how much money American companies can make next year, even at a slow GDP growth rate, because we are anniversarying tough comps. So that's the linkage. As long as you get the earnings leverage, 2 versus 3 versus 4% GDP growth doesn't matter as much, but that leverage needs to come through really hard and really fast. And we've got to see it by Q4 of this year in order to really believe 2022 and 23 are going to be, say, 220, 230, and then 250 a share for the S&P, which is kind of the cadence you need to see to believe in equities here.
Thank you again, Nick. And we have another question. This one's on the VIX. What's your take on overall declining volatility, but these very hot pockets in markets, be it crypto or mem names or Archegos concentrated positions in certain names, et cetera? How do you view this froth?
Yeah, it's a great point. So Jessica mentioned the declining correlations among sectors, and that's a super important point, because when you have lower correlations, first it's healthy because you want to see that different sectors should move in different ways. That shows you the market is actually working correctly. But it has the effect of lowering the VIX, because as correlations drop, the different sectors offset each other and volatility declines. And Jessica described that dynamic very well. The underlying point of the question is harder to answer. Archegos was just a mess. Having worked at a hedge fund, a big hedge fund, having worked at Credit Suisse, which took a big chunk of losses, I can actually absolutely see how it happened. The investment banking business is very competitive and nobody wants to be caught out. So everybody will sign up any client they can possibly rationalize doing business with. And Archegos was absolutely sort of the marginal client you shouldn't have gotten. So big misjudgment, and several people are paying the price for it. The crypto thing is different, and we think about that a lot. I was actually the first analyst on Wall Street to cover crypto, like right about Bitcoin back in 2012 and 13. I just thought it was a cool technology. It's kind of evolved, and it's become two things. Bitcoin has become kind of a gold substitute in some ways for a younger generation that trusts technology more than they trust physical assets. And then Ethereum is kind of like the more recent hot thing, because it ties into this non-fungible token NFT art world craze of printing digital artwork. And that's kind of a different phenomena altogether. And a lot of very smart VCs are very excited about Ethereum and NFTs. Andreessen Horowitz, for example, if you want to listen to some good podcasts, Andreessen Horowitz A16Z podcasts are fantastic. And there's a very good one on NFTs. So if anybody in the audience has an interest, just go to the podcast store and download those. They're free and very informative. But I don't think that it is necessarily only a function of liquidity. I think there's just a natural interest in technology among a younger generation, and they're more willing to embrace new ways of doing things on a tech platform than perhaps my generation was. I mean, I think Jessica's generation gets it a lot more than my generation does, in terms of understanding that you don't have to physically look at something or own it physically in order to have ownership attributions like NFTs or Ethereum allows. So I'm not willing to say crypto is kind of a sign of the apocalypse because it's kind of stupid. I understand why people feel that way. But I think there is something else going on here. Look, at DataTrek, we write a disruption section every day for clients because we do believe that these things are somewhat permanent changes to societal values. And so I'm not willing to say that collecting NFTs is any more dumb than collecting sneakers, which I've never really understood either. But it is a thing. And so I'm not willing to say that it is a sign that there's just too much liquidity and people are doing stupid things. I kind of think it's a societal change.
Alrighty, Nick, thank you. And I'm looking that we've cleared the Q&A queue there. So I think with that, we're going to conclude our monthly CAPAS research call. We'd like to thank everyone for attending, and our next call will be on May 20th, featuring Katie Stockton of Fair Lead Strategies. So please stay tuned, and don't forget our upcoming virtual roundtable on May 6th, Bank Trust and the Trading of Low-Price Stocks. On behalf of the CAPAS family and DataTrek, thank you all so much for watching, and have a great, great trading day. Thank you, everyone. Bye.